All right, everyone, it's March 13th. We've got to talk about what's going on. The elephant in the room, obviously, is Silicon Valley Bank, the bailout. And most importantly, for what I do, how does this impact mortgages? How does this impact the housing market? That's what we're going to talk about in this video. So let's start off with Silicon Valley Bank. Silicon Valley Bank is a very large bank that I think it was 13th largest in the country. That basically went insolvent on Friday, meaning that they could not fill their customers' requests to pull out money. Now, what we picture when we hear a run on the bank, that's the term the media uses, right? A run on Silicon Valley Bank. We picture you and I lined up to go in and empty out our checking and savings because we don't have confidence in the bank anymore. That's not what happened. Silicon Valley Bank, I'll say what their mistake is or was, is they are very, very heavy in, guess what? Silicon Valley companies. So as we all have been hearing over the last few months about tech layoffs, companies lay off when they're not making money, right? So we have to reduce overhead. Well, if that's happening, there's two ways to make payroll. You can take out a loan, short term, hey, let's just get through this. We'll take out a loan. It'll have a good interest rate. That's one way to cover our payroll costs. Or you have to pull money out of your accounts. Well, because the Federal Reserve continued to jack up rates and just kept doing the same thing over and over, expecting a different result, which has not yet happened. They keep raising rates and it's done nothing, right? But they thought if we keep raising rates, that's going to create pain for the American public, which is going to mean that they're going to stop spending money, and that will bring inflation down. Inflation going down basically means people are not spending money anymore, which drives prices down. It's supply and demand. Well, if you need to make payroll and you can't take out a loan because they're too expensive now because the Fed has made loans so expensive, what's the other alternative? To pull the money, let's just pull our money out of Silicon Valley Bank. Hey, we got payroll coming up. We need to make payroll. If all these companies did that at the same time, there's not enough liquid money at Silicon Valley Bank to do that. So it wasn't individual people lined up at the front door scrambling to get their money out. It was these big companies that need to pay their people, and Silicon Valley Bank had their money tied up in investments. So it's not that Silicon Valley Bank didn't have the money, it's that they didn't have access to it. It'd be like if you had stuff invested in long-term CDs, or let's just say, I don't know, you have your money in a stock account and it takes 3 days to liquidate. But your friend says, hey, dude, I need that $100 I lent you. I need it right now. And you're like, well, I don't have it right now. I'll have it in 3 days. I just got to liquidate this stuff. No, bud, I need it now. Kind of the same thing, like horrible example, but that's basically what we're seeing here. So it's not a question of do they have the money or not. It's just they don't have access to the money. Well, the depositors need to be supported. The people need to get paid. So I knew that the bailout was going to happen. It was kind of an absolute no-brainer. Friday night, I was like, no, there's no chance they don't do a bailout. Sure enough, Sunday afternoon, they announced they're going to do the bailout of $25 billion. Now, that is protecting the people's money. I'm not a fan. I'm not a big government fan. It's not my thing. I think we're supposed to in America, the government's not supposed to run us. The people are supposed to run the government. But in this case, it's not us as taxpayers that are going to necessarily pay that back. There's an opportunity for money to be made because, again, they have the money tied up in long-term investments. If they did not do this bailout this morning, Saturday night, I was like, Monday's going to be chaos because people will line up, right? Once the fear is driven of there was a run on a bank, then everybody goes, oh my gosh, what if my bank goes down? I need to go get my money out. But it's Saturday and I can't get it. So Monday morning, 9 a.m., I'm going to be in line. I'm getting my money. I'm screw the banks. That's what I was scared was going to happen this morning. And it's not what's going to happen. I mean, there will be that, right? You're going to have people who are like freaked out, fearful, that are going to pull all their money out in cash and put it in a safer shoebox. That will happen today. But overall, I don't think it's as big of an issue for us individually worrying about checking, savings, things like that. Not the bigger bank. When you put money into a bank, they're leveraging your deposits to earn interest. That's how banks make money, right? So we have to watch out for that. So like portfolio mortgages, like Silicon Valley Bank. Silicon Valley Bank is in my backyard. They were doing loans in the 4s, 30-year fixed rates in the 4s, if you met certain criteria, when the market was 6.5, even 7. Why are you doing below market rates, right? It sounds good to us, right? I would love to have a rate in the 4s, but the market doesn't want it because it's lower than market. So there's no place to put that. They have to hold on to that money. And a 30-year fixed mortgage is a great long-term investment, but it's not good short-term. So if they try to sell a portfolio, because that's what they call it, portfolio lending, right? That's what credit unions, community banks, things like that do. If they have it in a portfolio and they go, hey, we need access to money right now. we're going to give you this portfolio of rates in the 4s. And people are like, why would I want that? Market's at 6.5. Why do I want 4s? Get out of here. Or I'll buy it, but I'm going to give you pennies on the dollar for it, right? It's not a good solution. It's a good long-term, not good short-term solution. So that's really what we're seeing. So what happens to mortgage rates as a result of this? Well, I didn't know how it was going to turn out. I went through 08, lived through that whole thing, and it was a nightmare. It was a mess. There was a ton of volatility in the market. But what's happening, and this is a good sign for housing and a good sign for mortgages, is mortgage bonds are doing incredibly well today. We're recovering. So let me show you what is going on with mortgage bonds. Mortgage bonds create mortgage rates, right? So if bonds do good, go up, rates go down. So take a look at this. Here's mortgage bond trading over the last 3 days. So this is today, this is Friday, and then this was Thursday, right? So Thursday was good. Friday was great, but look at how volatile it was. So what happened, what this line means is the market did well. It got all the way up to here, and then investors were like, uncertainty. We don't know what's going to happen. And it ended down here, right? So this shows a lot of uncertainty. Well, today, we have a little bit more uncertainty, but people are moving their money out of stocks into bonds because it's safer, right? Just like Silicon Valley Bank. They had bonds because they're safer long-term investments, but they can't access them. That's the problem. When we look at this, we go, oh my gosh, rates must have gotten so much better. They're better, but not dramatically better. So let's do a longer term look. Let me get rid of these lines so this is not so cluttered. So this was November 10th. This is when the inflation report looked really, really good, and mortgage bonds rallied on that because we want inflation to go down. That's the goal here, right? Inflation goes down, mortgage rates go down. Well, then we were bouncing around in this range from November 10th all the way to the beginning of February. So that's almost, 3 full months. And then the whole month of February, things got worse. So we've recovered in just 3 days from being at the worst place we've been in the last, 4 months. We recovered more than half of what we lost in February as a good thing, meaning mortgage rates are getting better. Well, we really want to get back up to these levels, right? I'd say this is like 30-year fixed, depending on certain criteria, is probably like in the low 6s at this level. Maybe here it was dipping to like 5.875-ish. Of course, this is credit score dependent, how much you're putting down, all those details matter, but just generally speaking. So I'm wanting to break through this ceiling, right? If we break through the ceiling, mortgage rates get a lot better, but we've been stuck here in the past. We were here in September, we were here in November, right? We need to get above this ceiling. So the last time we saw that was back in, September of last year, really August. So we have a long way to go is the point. The good news is that mortgage bonds are doing well today on the bad news of everything that's happening. Stock market freaks out, moves money to more secure assets like mortgage bonds, things like that. So we're seeing improvements in interest rates, but not dramatic. It did not improve by 1%, nothing like that. So obviously I'm keeping a very close eye on this, and I will continue to do new videos to update you. But I'm not freaking out, right? I am not in line at my bank to pull my money out because I think it's going to go to nothing. With part of the bailout for Silicon Valley Bank, so FDIC insurance for banks means that as a depositor, don't worry, your money is safe here at this bank. If anything happens at this bank, Mr. Customer, we will backstop your money up to $250,000. That's what FDIC insurance is, right? So if you have $250,000 in an account here at Wells Fargo, Silicon Valley Bank, whatever, you're protected. The government's got your back on that. Well, what if I have $1 million? What happens to my 3/4, right? Technically, it would have been gone. Through this bailout, they said, don't worry, we've got all your money protected. Silicon Valley customers, don't worry, because you will have all of your money, not just the 250. You will have all of your money by March 14th. So they're doing something that I don't love, government interference in things. I just don't. It doesn't sit well with me because when there's no such thing as free money. When the government gives money, they're giving it out of our pockets because we pay it through taxes. But in this case, I think if they hadn't done something, you would have seen the run on the banks where individuals like you and I are running to the bank to get our money out. If you have any questions, let me know how I can help. Comment below. Let me know what you think. I'll be doing more video updates on this. I do, silver lining of this mess is mortgage rates are improving. Of course, in my line of work, I want to see mortgage rates improve. And if you do need help figuring out what you can afford and whether right now is a good time to buy or not, you can click the link below to schedule a meeting with me. I would love to help you personally any way I can. Thank you so much. Talk to you soon.